US bond yields edge lower as rate cut expectations rise, but French government bond yields have surged amid budget worries, and Australia's inflation jumps in July on higher electricity prices. That's coming up in our 5 Things in 5 Minutes on Thursday, August the 28th. In our deep dive interview, ANZ Senior Economist Miles Workman runs through ANZ Research's new forecasts for New Zealand.
The Reserve Bank seems to be attentive to these risks. Ultimately, their dovish pivot in August certainly solidifies the chance that the recovery does actually occur.
But first, in 5 and 5 with ANZ, US stocks rose overnight ahead of financial results from Nvidia, while shorter bond yields fell on renewed expectations for Fed rate cuts. The yield on the US 30-year bond, which rose yesterday on fears about Fed independence, rose again slightly as Fed Governor Lisa Cook indicated she would seek a court decision on her removal by President Donald Trump. Here's ANZ economist Bansi Madhavani.
New York Fed's John Williams said that every policy meeting is live for rates decision, which implies his readiness to consider cutting rates at the upcoming September meeting. He noted that inflation is coming down slowly and indicators such as hiring are signaling a gradual cooling in the labor market. And what that tells us is that he potentially leans in favor of moving gradually on cutting the policy rate.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and Nasdaq were up 0.2%. The 10-year US Treasury yield was down 1.5 basis points at 4.241%, and the 2-year was down 2 basis points to 3.625%. Gold was up 0.4% to $3,447 US an ounce. West Texas oil futures up 1.1% at $63.93 US dollars a barrel. The US dollar index was down slightly, the Aussie dollar though up 0.4% on 65.11 US cents, and the Kiwi up 0.2% at 58.63 US cents. Number 2. France's government borrowing costs have surged in recent days, with its 30-year bond yield rising to a 14-year high of 4.45%. Bansi says this has been triggered by the French Prime Minister's attempts to drive through 44 billion euros of spending cuts and tax increases.
The whole point of the package was to reduce budget deficit over time. So he's targeting 5.4% deficit this year and bringing it down to 4.6% in 2026. But the opposition parties are resisting these deficit-cutting budget measures. So the confidence vote is Bayrou's way of garnering support and emphasizing the critical nature of French public finances. The problem is that the current government is a minority government, so it remains very vulnerable to opposition parties refusing to back the confidence vote.
Number 3. Australia's monthly inflation indicator jumped to 2.8% in July from a year ago. It had been 1.9% in June, and that was well above expectations. Here's ANZ Senior Economist Adelaide Timbrell on what drove the rise.
This mostly came from a huge increase in electricity inflation from almost negative 7% in June to positive 13% in annual terms in July. And this was off the back of a 13.1% monthly increase due to the end of state-based rebates. So the Queensland, WA and Tasmanian state governments providing rebates to consumers on electricity created big drops in electricity prices, which have since been coming back up to normal, and July was a really big month for that. We also saw holiday prices jump in July, and fuel prices on an annual basis were also up.
Number 4. Adelaide says the Reserve Bank of Australia would likely look through the volatility for now.
The Reserve Bank knows that those state rebates are rolling off. I don't think that's something that's going to be a surprise to them or change their approach on monetary policy. When it comes to those holiday prices, they do bounce around a lot in the data, and it's not something that you'd want to change policy on unless you saw a sustained trend. And then on fuel, it did rise in annual terms actually from about -8 to -5.5, but in the month it was flat.
Number 5. Australian construction work also beat market expectations in the June quarter, up 3% in the 3 months. Adelaide says that while there was overall strength, the key public sector works input, important for GDP, remained weak.
Most of the rise came from private engineering construction. So a huge amount of kind of civil and engineering works from the private sector bringing up the overall amount of construction. Whereas the public sector, which saw a 4.7% fall in Q1 in terms of their construction work done, had another fall of 0.4%. So the kind of expected bounce back of public sector investment really has not happened based on this construction work done data.
Adelaide Timbrell there. Now, in our deep dive interview, ANZ senior economist Miles Workman has published ANZ Research's latest quarterly outlook for the New Zealand economy.
So it shouldn't come as much of a surprise given the high frequency data that we've seen over Q2 to hear that we've made a downgrade to our Q2 GDP forecast. It's a relatively small downgrade. We've gone from positive 0.1% quarter on quarter to negative 0.1% quarter on quarter. And of course, we're going to get a lot more partial indicators in the lead up to that print. So, we'll be firming that pick up as we get closer to the actual data release. The upshot here is we do expect Q3 to deliver positive growth. We've penciled in 0.4% quarter on quarter, but that is relatively modest growth. The big picture story there is ultimately, we have an economy that has been a little bit mixed in the sense that the bright spot has been our agricultural sector. But the thing about the primary sector there is it can't lead growth sustainably. It's just too small in terms of its overall share of the economy. You don't really get a sustained recovery in New Zealand unless you've got the household sector with a little bit of momentum under its belt there. So if you think about the household sector, you've got cost of living pressures, you've got a housing market that's going broadly sideways, and you've got a labour market that still probably has a little bit further to weaken from here. We actually expect the unemployment rate to peak in Q3 at 5.3%. So those things together suggest that while there is relief coming with OCR cuts, further OCR cuts, we continue to expect the OCR to get down to 2.5%. But the upshot is households still face quite a broad range of headwinds, and that suggests that the recovery that we will see in economic activity over the next 6 months or so is likely to be relatively modest.
And I guess just as that momentum eases or is less than previously expected, does that affect your CPI inflation forecasts at all?
So the CPI inflation forecasts, we've actually increased the near-term forecast. So Q3 CPI, we've upgraded our pick there from 2.9% year-on-year to 3% year-on-year. But that fully reflects tradable inflation. Now, tradable inflation is the side of the CPI basket that's quite volatile, bounces around quite a lot because of fluctuations in oil prices and the New Zealand dollar, etc. And one thing to remember with tradable inflation is generally what goes up must eventually come down. So if you look through that, non-tradable inflation is still expected to continue slowing to a level that's consistent with stable inflation at 2%. And in fact, you get to 2026 and we are expecting the tradable side of the basket to combine with the still slowing non-tradable side. And the payback that we see or expect in tradables is actually expected to see headline inflation come in slightly below 2%. So it's a bit of a mixed picture when you put the inflation outlook together, but the upshot is slightly higher in the near term for headline inflation, but we think it's appropriate that the Reserve Bank look through that because underlying inflation is still expected to slow over the next year or so.
You mentioned that a lot is going to be reliant on the household sector essentially picking up the baton, but there's still quite a bit of uncertainty there around the labour market. Is that the largest risk, would you say, around your forecasts?
I think one of the key risks here is that we are seeing evidence that firms are holding on to labour in anticipation of an eventual recovery. And of course, you've got to ask questions around how much balance sheet capacity do these firms actually have to keep doing that. And the upshot is if the recovery just doesn't arrive with the same amount of gusto that firms have been hoping to see, there is a key risk that they have to shed some of that hoarded labour. And our analysis suggests that could be worth about 0.5 percentage point on the unemployment rate. The good news, though, is that the Reserve Bank seems to be attentive to these risks. Ultimately, their dovish pivot in August certainly solidifies the chance that the recovery does actually occur. And so while the recovery might be a little bit delayed versus our previous expectations, we wouldn't classify it as a derailed recovery. There is support on the way through easier monetary conditions.
Miles Workman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, August the 28th. Catch you tomorrow with analysis of rates decisions in Korea and the Philippines. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.